This video covers the subtleties of making profits in crypto market. So we will also look into the most efficient crypto trading techniques. And besides guidelines and rules, every strategy covered in this video describes market movements analysis methods so that you open trades deliberately and understand the logic behind bulls and bears behavior. So let's start with the cryptocurrency technical analysis. So one of the basic market study techniques is a technical analysis. It includes strategies tailored to different periods, from scalping in 1 to 2 minutes timeframes and swing trading in hourly timeframes, up to even a day trading and position trading in a daily and weekly timeframes. So technical analysis is subdivided into a few types based on the approach and instruments used. So first we have the pattern analysis. So history repeats itself. Crypto strategies based on chart analysis imply searching for repeated charts move or patterns, including triangle, wedge, head and shoulders, double top, etc. Chart analysis will help identify price reversals or trend continuation patterns even if you are a beginner. Another tool is support and resistance levels. So they indirectly measure a trend's strength and determine eventual profit fixing points and help you place stop loss and take profit. Next, we have candlestick analysis. So that's an appropriate analysis method for trading crypto that allows quickly getting information on the current market sentiment. With the candlestick analysis, you can predict price directions based on the results of previous trades. So this technique is one of the easiest methods for beginner traders to learn. Then we have algorithmic method. So a lot of crypto selling strategies are based on algorithmic methods. They include all trading strategies that use technical indicators such as moving averages, the golden cross or the death cross. Counting all the technical analysis indicators would be hard since there are dozens or thousands even of them. Then we have volume analysis. So to have an idea about the market's current state, we can use trade volume indicators for various timeframes. Comparing these data to the periods of quotes, growth and fall, traders can figure out what is happening in the markets. Next, we have news and sentiment analysis. So news trading is a strategy borrowed from traditional trading, of course. Crypto quotes can be affected by the news about a particular crypto project or the crypto market as a whole. When trading crypto assets, analyze BTC-related news. Political and economic developments can also impact on crypto pairs, just like central bank decisions. For example, a ban on crypto trading will significantly drop crypto rates, naturally. So, the Ethereum USD chart here shows a drastic upward and downward price movement. All of them are related to important events. Traders must note assets that are under pressure. For example, the Fed's key rate changes affect the dollar cost. As a result, a crypto buying strategy can extend to other USD pairs, while Ethereum creator Vitalik Buterin's tweet will likely impact only on the Ethereum price. Creating a medium-term news trading strategy for cryptos is impossible. Unlike in FX, there is no economic calendar for the crypto market, so we don't have reporting publication dates, statements, or central bank decisions. The websites that position themselves as crypto calendars can only offer an approximate idea of possible events. Such information can be used only as an additional factor to place stop-loss orders more accurately, thus lowering eventual risks if the price reverses sharply. So, top 7 cryptocurrency trading strategies. So we have gathered a few crypto trading ideas used by most successful traders. Once you've tested some of those, you will no longer consider cryptocurrencies a mysterious high volatility asset. So first, position trading. This crypto trading technique suggests holding positions for a long time. It's called HODL. It is short from hold on for dear life in the crypto world. That's a pure investment philosophy when investors firmly believe in a bright and rich future for all those who continue holding cryptos, whatever happens. So position traders base their decisions on an assumption that assets yield profit in the long term. Potential growth relies on fundamental factors, macroeconomic analysis, and long-term market cycles connected with Bitcoin's halving. So position trading suggests holding assets for a long time, so traders ignore short-term market fluctuations or crypto day trading, rather focused on global trends. Then we have swing trading. So this strategy is used to make profits from short-term and medium-term price movements. Swing traders hold positions from a few days to a few weeks. The strategy is based on the idea that price moves in cycles, growing and falling, and market participants use chart patterns and fundamental analysis to identify potential entry and exit points. They look for strong trend signals and try to enter the market at the best price to make the biggest profits. And this cryptocurrency trading strategy demands a deep understanding of trend indicators, patience, and discipline. Now we move on to day trading. So it's probably the best cryptocurrency trading strategy and the most popular one. Under this strategy, traders open trades and exit the market at the same day. Such a strict time frame was first meant for trading in traditional markets, when trading activity was recorded only during particular hours, the working hours of a stock exchange. So intraday traders have never kept their positions open overnight because the market was closed at night. Daily crypto futures and currency trading strategies can now be used because crypto stock exchanges are open 24 hours a day. So the day trading term now implies short-term trading where traders aren't held for more than 24 hours. So to develop trading strategies, cryptocurrency traders use technical analysis, chart and candlestick patterns, and other techniques. And day crypto trading can turn out highly profitable on small time frame charts due to high volatility, but the risk is also high. Almost all crypto pairs suit intraday traders. The BTC-USD chart shows an example of day trading using the MACD indicator. So we have a bullish reversal signal on the H1 chart at the end of the previous day as the indicator's line crossed the signal line from below to above. So we open a long trade at the candle's closure with a stop loss at the nearest local low, which is the red line. There formed a reverse signal, given that the MACD indicator generates a signal with a lag and a correction has obviously started developing in the chart. So we should close the trade at the green line level. So let's discuss the next one, which is range trading. So range crypto trading aims to profit from non-trading directionless markets and flat periods. Assets are sold when they are overbought and vice versa. So range trading algorithm identifies support and resistance levels and buys an asset at a price close to a support level and sells it when the price has reached the resistance level but not yet crossed it. So to efficiently trade ranges, traders use volume data as the market sentiment indicator. There can be increased trading volumes ahead of a price movement. So this regularity can be used to confirm pullbacks from support and resistance levels. So let's check an example of range trading. So here, the purple lines mark support and resistance. A pullback occurs once the price reaches the lower boundary. The volume chart shows market activity growing, so we can conclude that the price will be rising, and we open a long position at the candle's closure, which is here the blue line. So then trading volumes fall once the chart approaches the support level, meaning most market participants don't want the price to grow any further. And these signals give us the reason to close the trade at the green line level. So we move on and go for another type of trading, which is scalping. So this is a good technique for traders who are not afraid of risky Bitcoin trading strategies and want to have a favorable return on the slightest price fluctuations. This method is best suited for trading high volatility cryptocurrencies, and the market must be analyzed on the smallest timeframe charts. Scalpers fix profits after just a few points move, so remember to consider commissions as well. A trade can be opened when the chart has crossed the moving average or the price pulled back from support or resistance. The price crossed the MA from below on the 5-minute Ethereum USD chart, so we can open a trade at the candle's closure once a breakout is fixed. A market entry point is marked with a blue line, of course, and a stop loss order should be placed below the exponential moving average at the candle's opening level. Next, wait for a moment when the price stops rising. A correction starts as a red candle 2 candles later. Once it's closed, fix profits and exit the market, which is marked the level on the green line. Next is HFT trading. So high frequency trading is a group of quantitative strategies implemented through algorithmic trading methods. HFT traders use complex algorithms to profit from market fluctuations that last seconds or milliseconds even. So HFT trading strategies are best used for volatile asset classes with simultaneous monitoring of several trading platforms. This trading technique suits only those traders who can develop and test a trading algorithm. You will need good knowledge of math and programming and skills for analyzing the effectiveness of trading bots. Next method is arbitrage. So this is a popular crypto sell strategy among those who trade on several stock exchanges simultaneously. It is based on making profits from the difference in an asset's prices on different trading platforms. So making money through arbitrage is possible since the crypto market isn't regulated. The difference between quotes on different stock exchanges can be significant, and the only inconvenience of this strategy is that identifying a money-making opportunity can be hard. You need to analyze hundreds of pairs on dozens of trading platforms, which is hard to do without using dedicated software. So how to avoid mistakes while crypto trading? So to trade cryptos with profits, finding a considered strategy isn't enough. It's important to avoid mistakes that beginner traders make. So first one is fear of missing out, the popular FOMO. Then we have overtrading and too many ideas syndrome. Next one is trading more than you can afford to lose. The next point is superficial market research, revenge trading, and too much trust in another person's opinion. So you have probably met people who are always afraid to miss out on something. Beginner traders constantly do that. It's called the FOMO effect. As I said, fear of missing out. It shows itself as a strong and sometimes uncontrolled fear of being out of the market even for a short time. Such people continuously follow quotes and news and open trades as soon as possible. Such trades aren't effective, let alone the quality of the market analysis. So next problem is the overtrading. So this mistake of beginner traders is somewhat similar to the previous one, with the difference that overtrading is an itch to buy or sell at all time, irrespective of FOMO. Such traders tend to trade continuously without noting trading prospects and risks. Trading is first and foremost a deep analysis and patience. A position should be opened after some potential has been identified. In some trading strategies, a few trades are opened a week or even a month, but they yield profits that exceed the effort spent opening dozens of positions. Next point is the cognitive mistakes. The trading psychology is as important as crypto market analysis. Even the best traders can make psychological mistakes and lose money. For example, traders often invest more than they can afford to lose while running after big money. So closing a bad trade in time and getting off with small losses is sometimes hard because you simply can't part with your money. So you continue hoping that the market will reverse in the right direction. So finally, the trade closes all the same, but the loss is much bigger. So then the problem is with not doing enough research on your own. So the information field is overflowing with expert analytical materials. Many beginner traders don't even try to learn to analyze the market thoroughly, relying on internet forecasts. But I think if everything were so simple, millions of traders could make stable profits without developing their own crypto trading strategies. Thus, the best option would be to make trading decisions based on your own analysis. At the same time, don't ignore analytical reviews. They are a good basis for research. You will also find missed signals in other traders' predictions. Considering other traders' errors, you can correct your own forecast. Next problem is making trading calls based on hype. So a craze for whatever can be groundless. Even if most traders believe in the fast growth of a coin, it can turn out that all the crazy comes from a well thought out hype campaign. So don't think that a new token will be forever popular, and think carefully before investing in little known projects. Cryptocurrencies are a few times more volatile than traditional assets, so an option trading Bitcoin strategy called straddle has adequately proven itself in crypto trading. Two types of a position are singled out under this strategy. Long straddle means that a call option and a put option are bought simultaneously with the same strike price and expiration date. You can exploit a straddle position amid growing volatility irrespective of where the market is moving. Short straddle is when a put option and a call option are sold with the same strike price and expiration date, while selling traders earn a profit during low market volatility. The less the market moves, the higher profits are. So we should note that options trading in the crypto market is a niche business-only professional engage in. Regarding regular speculators, Bitcoin volatility trading is the most popular with swing traders. They often use volatility indicators such as Bollinger Bands, average true range, and volatility index. So the key points from the video are as follows. The cryptocurrency market is dynamic, providing a good opportunity to augment your capital quickly. At the same time, risks are also higher as predictability is lower than in traditional markets. The time window for making a decision is much smaller in the crypto market as well. You need to act as fast and react to changing market conditions. So it's important to choose the right crypto strategy and time frame for crypto trading. For short-term traders, a strategy must comply with two requirements: be efficient in high volatility conditions and produce leading signals so that you can respond quickly to any changes in the trading environment. A long-term strategy implies a few false signals and minimum lagging. And guys, on that note, I will end this video. Of course, do check our channel for other financial videos like this one. And yeah, I'll see you in the next video. Take care, guys, and goodbye.